Hello and welcome back to what could be one of the most crucial Sunday motivational videos you've ever watched. By the end of this video, you'll understand how to keep more of your hard-earned money than ever before. When you search for this kind of information online, you'll often find advice about maxing out contributions and other common tips, but that's not really what you're looking for, is it? Albert Einstein famously said, "The hardest thing in the world to understand is the income tax." The wealthy have access to expensive accounting experts who help them minimize their tax payments significantly. Over the last decade, we've gained substantial knowledge in this field, allowing our companies and personal wealth to grow rapidly. Write all of this down because you never know when this information will come in handy. This isn't financial advice, but rather insights into strategies the rich use to grow their wealth. And we believe it's valuable for you to know about them too. Here are ways rich people pay little to no taxes. Number 1. Reinvest profits. The rich don't let cash sit idly unless they need it for something specific. Here's the golden rule when it comes to paying taxes. Reinvested profit is not taxed. If your company is about to make $5 million in profit and you choose to reinvest that amount back into the business, before the end of the fiscal year, you don't have to pay taxes on that $5 million. This strategy allows companies to grow rapidly. As the business owner, your net worth skyrockets, with little to no tax to be paid. Number 2. Own everything through a business. The second golden rule of tax optimization is deduct everything. If a business needs something to function, the money spent on it isn't taxable. Want a new car? If the company needs it too, let the business purchase it and you get to use it since it's necessary for running the business. The more expenses you can deduct, the less taxable income you have. Number 3. Send it overseas. This is how companies like Facebook, Google, and Apple do it. They set up companies in Ireland due to its tax-friendly environment. These companies own intellectual property, and the US branch pays a licensing fee to the Irish company every year to continue developing and selling products in the US. This creates a legitimate deductible expense for the US company. Through this scheme, money is moved out of the US economy to Ireland, where the companies pay only around 1% in taxes, or even less with further optimization. If you live in a low-income tax country, you can set up a local company there and invoice your US subsidiary for rendered services, minimizing the tax burden in the US. Tech giants often prefer paying fines over paying their full taxes. The more you think about it, the clearer it becomes. A fine is a tax for doing something wrong, while a tax is a fine for doing something right. Number 4. Move to a low or no tax country. People often overlook how much moving to a place with low or no taxes can benefit their finances. In the past, this was a popular strategy. You could relocate to Dubai, Monaco, the Cayman Islands, or the Bahamas as your primary residence. These countries don't have income tax, so you don't have to pay taxes on your earnings. However, there's a downside. It's usually very costly to move to these places, giving the wealthy an advantage. For example, the cost of living in Monaco is extremely high. Despite these costs, the tax savings can still be significant. Number 5. Charitable donations. The fifth rule of taxes. Money given to charity isn't taxable. This is why many wealthy people own foundations. They believe the government often mismanages funds, so using a charitable foundation ensures their money has a positive impact on their community. Here's the interesting part. Even these tax-exempt foundations have deductible expenses. They need various resources to operate. You can donate land, vehicles, or other assets to a charity you control, and it still counts as a charitable donation. Additionally, as the head of the charity, you can still use the same car you donated on paper. Number 6. Buying art. Here's a little-known secret. The art market is one of the last major unregulated markets. When you buy a piece of art, it counts as an expense, and many of these expenses can be deductible. Imagine you earn $1 million this year and spend it all on a $1 million painting. Since the expense matches the income, there's no money left to be taxed. Fast forward 3 years, and the painting is now valued at $6 million. Instead of selling it for profit, you donate it to a museum or your own art foundation. This donation gives you a $6 million tax deduction. Assuming you're still earning $1 million per year, you've just saved an additional $5 million in taxable income, all legally. You can keep doing this. Let's say you sell the painting for $6 million, making a $5 million profit. Normally, you'd be taxed on that profit. But if you reinvest the $6 million into more art, you don't have to pay any taxes on the profit. This is why the wealthy invest in art. This is the type of insider knowledge you get by subscribing to our channel. You won't find this information anywhere else. Number 7. Use privacy coins. Cryptocurrency is transforming the way we handle wealth transfers and security. Imagine being able to carry $1 billion on a USB stick, put it in your pocket, and fly to Singapore with it. That's the potential of crypto. While Bitcoin and Ethereum are heavily regulated to ensure transparency and fair taxation, profits from crypto sales are taxed at only 10% in most countries. This offers better returns than some traditional assets, especially considering the industry's rapid price growth. But there's more. Blockchain technology has introduced a new type of currency called privacy coins. These coins can be exchanged, stored, and transferred completely anonymously. Although their legality varies by jurisdiction, privacy coins are not illegal. The most popular ones are Monero, Dash, and Zcash. The idea is that once you earn your money legally, you should be able to spend and transact with it privately, without anyone else overseeing your transactions. Number 8. Using a trust to avoid estate tax. There's a saying among the wealthy: you don't realize how much you have until you have to pay taxes on it. Here's something you might not know. If you're wealthy and pass away, the state can tax up to 45% of the wealth you want to pass down to your children, known as the estate tax. In the US, you're considered wealthy if your net worth exceeds $11.7 million. For those worth less, the estate tax is either non-existent or significantly lower. While $11.7 million may sound like a lot to most people, we're talking about billionaires, and we might even see the first trillionaire in our lifetime. With inflation, it's likely that many more people will become millionaires. To protect their wealth from heavy taxation, the rich use trusts. By placing assets into a trust and meeting certain conditions, these assets no longer legally belong to the individual, thus avoiding estate taxes. Once property is held in a trust, it's excluded from the estate for inheritance tax purposes. This also prevents the risk of leaving all your wealth directly to your children, who might squander it. Control of the assets remains with you while you're alive. You can set up conditions, similar to smart contracts, where your children receive gradual access to the trust's assets under specific circumstances, such as reaching a certain age or graduating from school. Number 9. Using a trust to avoid estate tax. Among the wealthy, there's a saying: you don't realize how much you have until you have to pay taxes on it. If you're wealthy and pass away, the state can take up to 45% of your estate. In the US, being wealthy means having a net worth over $11.7 million. Below this amount, estate taxes are minimal or non-existent. To protect their wealth, the rich use trusts. By placing assets in a trust, they avoid estate taxes since the assets no longer legally belong to them. Trusts also keep assets from being squandered by heirs. You can set conditions where your children gain access to the assets gradually, such as upon reaching a certain age or graduating. Thank you for watching. If you have any tax inquiries or need expert tax services, we're here to help. Feel free to reach out to us via email at thewealthsync1@gmail.com. Don't forget to like, share, and subscribe for more finance tips and advice. See you in the next video.